Stocks are up, gold is up, Bitcoin is up, bonds are catching a bid, real estate is holding. Your coworker who bought Palantir at $9 just leased a BMW. Everything is going up at the same time, and everyone seems fine with it. Now, I don't want to be the guy at the party who points out the guacamole is turning brown, but when every asset class rallies simultaneously, it usually means one of two things. Either we've entered a new golden age of permanent prosperity, which historically has a success rate of exactly 0, or the market is pricing in two completely contradictory outcomes at once and hoping nobody notices. Spoiler, I noticed.
Let's set the table. The S&P 500 has ripped higher, recovering basically everything from earlier tariff panic. The Nasdaq is on a tear, driven mostly by AI enthusiasm that shows absolutely no signs of touching grass. Gold just hit another all-time high, because apparently fear and greed can coexist in the same portfolio. Bitcoin is flirting with levels that make 2021 look quaint. And the bond market, which spent most of last year being the financial equivalent of a dumpster fire, has started rallying too, with yields pulling back. On the surface, vibes are immaculate. But here's the thing that's nagging at me. Gold rallies when people are scared. Stocks rally when people are confident. Bonds rally when people expect rate cuts, usually because the economy is slowing. And crypto rallies when liquidity is loose and risk appetite is wide open. These assets are telling 4 different stories, and the market is reading them all as bullish. That's like getting a text that says, "We need to talk," "I love you," "I'm moving to Portugal," and "What do you want for dinner?" all from the same person, all at the same time. Something does not reconcile. All right, bear case. Historically, the everything rally tends to show up in late cycle environments, right before something breaks. Not because the rally itself is dangerous, but because of what it requires to exist. What fuels it? Liquidity expectations. The market is essentially front-running rate cuts, fiscal loosening, or both. It's pricing in a world where the Fed rides to the rescue, inflation stays tame, earnings keep growing, and geopolitical tensions resolve themselves over a nice dinner. That's a lot of assumptions held together with vibes and a prayer. Meanwhile, leading indicators are softening. Consumer credit is stretched, small business optimism looks like my dating life, technically alive but not thriving, commercial real estate is still a slow-motion train situation, and corporate earnings, if you strip out the Magnificent Seven, are fine. Just fine. C+ student who's coasting, fine. The risk here isn't a sudden crash. It's a slow rotation from everything up to actually some of this was priced wrong, and then a very uncomfortable repricing that makes people age a decade the way shorting Nvidia does. Now, in fairness, the bulls aren't delusional. They're just optimistic in a way that requires several things to go right simultaneously, which, to be fair, sometimes happens. The AI productivity story is real. Not every company slapping AI on their earnings call is lying. Some of them are genuinely seeing margin improvement. Enterprise adoption is accelerating. CapEx spending from hyperscalers is enormous, and that money is flowing somewhere. The labor market, while cooling, hasn't cracked. Unemployment is low by any historical standard. Wage growth is moderating but positive. The consumer is bending, not breaking. And the Fed, love them or roast them, has room to cut. If things actually do slow down, they've got ammunition. That backstop matters. It's the financial equivalent of knowing there's a safety net, even if you'd rather not test it. So the bull case is essentially soft landing achieved, AI drives the next productivity boom, rates come down gently, and we all pretend the deficit doesn't exist for another few years. Honestly, it's not impossible, it's just priced to perfection. And perfection, in my experience, is usually what happens right before your laptop dies during an unsaved Excel session. Here's where I actually land. I don't think this is 2000. I don't think it's 2008. I also don't think we're entering some frictionless utopia where every asset goes up forever and your neighbor's altcoin portfolio outperforms Yale's endowment.
What I do think is that the market is in a buy now, ask questions later mode, driven by liquidity expectations and momentum, and those regimes can last longer than you think, until they don't. The most likely outcome, some of this rally is justified, some of it isn't. And over the next 6 to 12 months, the market will start differentiating, rewarding companies with actual earnings growth and punishing the ones that were just along for the ride. That's not a crash. That's just markets doing what markets do when the sugar rush wears off. The move, in my view, isn't to go full bear and hide in cash. It's also not to go full bull and YOLO into momentum. It's to stay invested, stay diversified, and maybe, just maybe, resist the urge to interpret everything going up as confirmation that you're a genius. You're not a genius. I'm not a genius. We're all just standing in a river of liquidity, hoping it doesn't change direction. Look, the everything rally feels good. It's supposed to. That's kind of the point. Markets feel the best right before they ask you to pay the bill. I'm not saying sell everything. I'm not saying buy everything. I'm saying the moment every asset class agrees that the future is bright is precisely the moment worth asking, what am I missing? Because the answer is almost never nothing. Thanks for watching. If this made you think, even a little, consider subscribing. I don't do hype, I don't do fear, I just try to make sense of things while mildly roasting the market. I'll see you in the next one.